What's the story with the Bitcoin ETF? Bitcoin has arrived on Main Street with the launch of a US exchange-traded fund. That matters because it opens up what was once a very niche investment to a much wider pool of potential buyers. You no longer need an account with a special cryptocurrency exchange or a futures trading venue. Now, anyone with a brokerage account can get price exposure. There's been a lot of excitement in the weeks immediately following the launch. The market cap of the fund shot to $1.3 billion. What's more, this is unlikely to be the last ETF tracking the price of Bitcoin. But you really need to read the fine print. When you put money into a gold ETF, the custodians use the money to buy actual bars, which they then store in a vault. That creates demand for the metal and the price rises. That's not the case with the current crop of US Bitcoin products. Instead, the SEC has decided to approve only products backed by cash-settled futures contracts. For now, at least. In other words, the assets that link the price of the fund to that of Bitcoin are futures contracts, which themselves aren't settled in actual Bitcoin, but rather in cash. That has two rather big implications for the bullish investors. Number one, demand is transferred away from actual Bitcoin to futures contracts. And unlike Bitcoin, the supply of futures contracts is potentially infinite. And number two, rolling the futures contract forward from 1 month to the next means that it is likely to substantially underperform Bitcoin when crypto is rallying. Which means that the lineup of crypto ETFs likely to emerge in the US will be more like trading vehicles and less suitable for the buy and hold Bitcoin bull, or the hodlers as they called. This is Decrypted. I'm Eddie van der Walt. For more content like this, follow us on your favorite platforms.